What's up guys? In this video we're going to be covering what time frame alignment is. This is a very simple topic, I will say, but it is very important and crucial to your success in trading. So let's get straight into it. So first thing you guys need to realize before we explain what time frame alignment is what candlesticks are and how they work. I already explained this in another video, but basically each candlestick represents time, price action. It represents what price did over a certain period of time. So if we look at the 1 minute time frame, each candlestick represents 1 minute of time and price action. If we look at the hourly time frame, each candlestick represents 1 hour of time and what price did in that 1 hour. And if we look at the daily time frame, each candlestick represents 1 day of price action, and etc. You guys get the point. If it's a 2 minute time frame, half an hour time frame, whatever. So if we look right here on TradingView, if you guys ever want to practice and look at the charts, you guys can see there are many time frames that you could choose from. So what is the importance of time frames? So guys, if you trade with only one time frame, you are basically trading blind. You want to always be looking at multiple time frames at the same time, because one time frame does not tell the full story. You want to have multiple time frames, and you want all these time frames to kind of tell the same story. If you're looking at the 15-minute chart and it's showing one type of setup, and if you're looking at the 5-minute chart and it's showing a completely opposite setup, then that's not good. You want them to be kind of telling the same story. And if the time frames contradict each other, then the setup is not valid. And you guys have a much greater success rate if there is time frame alignment on multiple time frames. So we're going to get into it. So what do we look at first? So you guys need to understand that when we are searching for setups and looking, trying to find a setup that we want to trade, we need to first start from the base and work our way up. So when we're analyzing a stock, you want to generally start with higher time frames and then work your way down to smaller time frames. This way you can see the bigger picture first. You can look at the overall picture, and then you're getting into the little specific price action. You first start off with the big picture, and then you're looking at the little details. When you first look at a piece of art, you don't just look specifically at the strokes or the little details of the art piece. You first look at the entire piece altogether and you see it. You see what it is. And then if you're analyzing the art, then over time you look deeper into it and you look exactly how the artist stroked his brush and which direction. The little birds that are flying in the sky. You want to first start off by looking at the picture first and then looking at these little details, not the other way around. So yeah, use this larger time frames to determine an overall bias on what direction and what's happening to the stock, and then we look at the smaller time frames to locate potential entries and exits. If you first try to look at the smaller time frames for specific entries and exits, and you don't look at the bigger picture, then you're not going to be successful. So yeah, if the entries, take profits, stop loss, and the support and resistance are very similar on all the time frames or on many time frames, the setup is better. So yeah, you want these time frames to kind of all be telling the same story. So yeah, some time frames have more importance during certain times of the day. So remember, the stock market is open from 9:30 a.m. to 4:30 p.m. Eastern time. And throughout the day, we prioritize certain time frames. So yeah. So first thing we need to go through before I explain the step-by-step process on which time frames we look at, you guys need to understand what is a gap in trading. So this is our whole trading strategy. We trade gapping stocks, and these are stocks that gap in price. They move in price overnight, which leads to a gap. So sometimes we see a lot of charts trading, a lot of the prices. Let's for example say it's trading at around $10 to $8. It's moving throughout $10 to $8 past few days, the past few weeks, and all of a sudden overnight it moved up in price to $20. On the chart, we're literally going to see a gap between the trading, the consolidation that was happening, and the new candlestick that's being formed. because it moved in price overnight. So there's literally a gap. So we trade stocks that have gapped in price last night, and we want to trade the stock in the direction that it gapped. So if it's a gap up, if it gapped up in price, we want to, find a way to play it long. We want to find a way to buy it. And if it gapped down in price, we want to find a way to play it short. And I'm just explaining this to you guys because in the next slides, you need to understand what a gap is. I'm not going to get into, the specific criteria of finding high quality gaps in this video. We're going to have a whole separate other video just for that. But you guys just need to understand what a gap is, because now we're going to cover the step-by-step, what we do step-by-step when we are analyzing the charts. So this is step one when we are looking for a setup. First thing we do, before the market opens, we look at the daily time frames to look for overnight gaps and the overall context on the stock. You first want to look at the big picture first, and we're trying to find some high quality overnight gaps. Step two, then we look at the hourly chart for more information. We're kind of making our way down. Now step three, these are the main time frames that we're going to focus on while we're trading. We focus on the 1 minute chart, the 2 minute chart, the 5 minute chart, and the 15-minute chart time frames, to find potential setups. And I just want you guys to understand that throughout the day, we look at all of these time frames no matter what. We're always looking at all of them, but at certain times of the day, we focus more on specific time frames. So from 9:30 a.m. to 10:30 a.m., we mainly focus on the 1 minute and the 2 minute time frames. But of course, we're still going to be looking at the 5. We're still going to look at the 5, but most of our decision making is going to be basically made off the 1 minute and the 2 minute. And then it's kind of overlapping, but from 10 a.m. to 11:30 a.m., our main focus is going to be on the 2 minute time frame and the 5 minute time frame. But we are still going to keep an eye on the 1 minute time frame and 15-minute time frame. Our main priority is on the 2 and the 5, but we're still going to look at the 1 and the 15 for context. And then from 11:30 a.m. to 4 p.m., our main focus is going to be on the 5 minute time frame and the 15-minute time frame. But we're still going to, use the 1 minute and 2 minute time frame for some of our entries and for some of our exits, and we still use them, but our main, strategy is going to be depending on the 5 minute and 15-minute time frame. Now, if you guys know what swing trading is, this is basically day trading, but over the course of a few days or a few weeks, and I'm just going to include a little slide for this in this video. For swing trading, we first focus on the weekly chart, then the daily chart, and then the 4-hour chart to find potential setups, and then when we use the hourly chart, the 1 hour time frame, to find the entries. Alright guys, so now we're going to get into a little practice, and I want you guys to determine which one of these, potential examples potential setups has a higher chance of succeeding, and which one you would take if you were taking a trade. Oh, and by the way, both of these we are looking to find a way to play them short. So we are looking for a short entry. We want to sell the stuff. So let's look at example one. The daily chart had a great gap down. So a gap down, so that's good. The hourly chart is bearish. It looks lower. It's moving lower, and it has a declining 20 period moving average that's overpriced. If you guys don't know what the 20 period moving average is yet, that's okay. We'll get into that in a different video, but you can still do this example. Let's say the 15-minute chart is bearish with a breakdown pattern, and the 5-minute chart is bearish with a declining 20 period moving average. So that is example one. Now example two is the daily chart had a great gap down, just like example one. The hourly chart is moving sideways. The 15-minute chart is looking bullish with a 20 MA curling underprice, and the 2-minute chart looks bearish with a breakdown setup. So pause this video, think to yourself, which setup would you take, and explain to yourself why. I literally want you to think in your head, which one would I take, and exactly why would I take that one and not the other one. So the answer is that example one is the better setup, because it has multiple time frame alignment. Each time frame looks lower. Each one is moving at a great gap down, and the hourly, the 15, and the 5-minute are all moving bearishly. They're all in like a downtrend. While example two, it did have a good gap down, but the hourly chart isn't bearish. It's moving sideways. It's consolidating. The 15-minute chart looks higher, it's bullish, and the 2-minute chart looks bearish. So obviously example 1 is good. And a lot of traders out there only trade off one time frame. So imagine you were one of those traders and you were only looking at the 2-minute time frame, and it looked really good as a, looked really bearish and it looks really good. But if you didn't look at the 15-minute chart that looks bullish, and if you didn't look at the hourly chart that's moving sideways, then you are you're trading blindly because you're not looking at the entire story. So you guys make sure to look at the entire picture when trying to find a setup, and this video should have just given you a basic idea on the importance of time frame alignment. Later on, we're going to get into all these specific details on what a gap is, what a 20 period moving average is, and all these other information. But you guys should just keep in mind that you want the time frames to be aligned and telling the same kind of story. If one time frame looks bullish and the other time frame looks bearish, the setup is not good. You guys want them to both be kind of moving in the same direction and kind of looking the same. So that's the intro to time frame alignment. I hope you guys enjoyed, and yeah, I'll see you in the next video.